Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and I want to thank you for joining us this afternoon as we take a look at the weekly's options on leveraged and inverse ETPs. Now, with us today, I'm very pleased to have Russell Rhoads. Russell is a senior instructor with the Options Institute, the educational arm of the Chicago Board of Options Exchange. Now, he's also a rather prolific author, having authored books such as Option Spread Trading, Comprehensive Guide to Strategies and Tactics, also Trading Weekly Options with Pricing Characteristics and Short-Term Trading Strategies. That's his most recent book. And I don't want to leave out Trading VIX Derivatives, Trading and Hedging Strategies using VIX Futures, Options, and ETNs. Now, Russell also instructs graduate-level option courses at the University of Illinois in Chicago. And I hear you've just unmuted your phone, Russell, so I'm going to move this over. Thank you for joining us. Let's put this on your slides, and I'll give you the ball so that we can get underway this afternoon. Thanks.
Okay. Thanks a lot, Cynthia. You always are so kind when you introduce me. If there were money in it, I would take you on the road if there were money in doing speaking tours on options.
Well,
so
we
I
are
always
so
appreciate
pleased to have you, so thank you.
You bet. So today I'm going to talk about weeklies, and weeklies, that word just drives me nuts sometimes because it is a singular. So weeklies is how I'm supposed to say that. Weekly options on the handful of leveraged and exchange traded products that have weeklies. We've got weekly options on well over 300 different underlying markets now, and a handful of them are the leveraged or inverse. Some people also call those strategy-based exchange-traded products. Before I get going, this is our disclosure statement. It's got a few extra lines in it because I'll be talking about funds that are put out by a couple of exchange-traded fund providers. It also is just to highlight that, and I don't think I'm going to use any trading examples today unless we get into it with the Q&A, but it basically just says if I do any trading examples, we're going to exclude commissions and just try to keep the math somewhat simple. So the plan over the next half hour or so, I'm going to talk about just weeklies, the evolution of them, the popularity of them, comment a little bit on why I think they're so popular and the uses that they've gotten. And then we'll just run through the leveraged ETPs and the inverse ETPs. Now, everybody's probably familiar with the term exchange-traded fund, and I'm sure most people are also familiar with the term exchange-traded note. I use ETP, and a lot of people have started using the term exchange-traded product, so that it's just an all-encompassing term to include an exchange-traded note and an exchange-traded fund. And then I'll talk about the option price behavior. I look at the option pricing on a couple of leveraged markets and relative to their underlying unleveraged, the ETFs that do the same thing but are unleveraged or not inverse. And despite some of the longer-term price activity from these exchange-traded products, especially the leveraged ones, the option price behavior was surprisingly, it was surprising to me. We'll comment on that when we get going. So weekly options were, and I also use the term short-dated options interchangeably with this. We introduced weeklies on individual stocks in, gosh, I want to say the last day of May or first week of June in 2010. The number of securities and markets has dramatically increased. We're well over 300. I think it's well over 350 names now. I've just gotten my summer intern, so the next time she asks me for something to do, I'm going to have her count how many names we have on the weeklies list. We also have something referred to as serial options, and serial options are I think, even an improvement. I think much of an improvement, or have been much of an improvement, on the weeklies concept, because now for many securities, in fact for a good number of the stocks with weeklies, we will have options that expire 5 or 6 Fridays in a row. So you can pinpoint an earnings event, and you can also start to get an idea of how much risk may be being priced into a stock for the week that they are going to report earnings. So serial options, we continuously list options that expire 5 weeks in a row. In fact, I'm fumbling through and taking a look at the weeklies list. In the equity space, we have weeklies that expire every Friday for the ones that have serial options through June 27th. So, wow, through the middle of summer already. There are a handful of these ETPs with short-dated options available, and that's going to be the focus of the discussion today. On the leveraged exchange-traded product side, these 6 funds are designed to match the daily, and I put daily in red and made it bold because daily performance does not necessarily match up to the long-term performance. The Ultra Silver, it's 2 times the spot silver price, I believe, in London. The Financial Bull, 3 times. That is the Russell Financials, 3 times that one. The Daily Gold Miners, 3 times the Gold Miners Index. And the Ultra S&P 500 is one that I guess he still is my boss. We're both senior instructors though, but Jim Bittman here at the exchange likes to do a lot of work with SSO versus the SPY exchange traded fund or the SPY options as well. The TNA is 3 times the Russell 2000, a heck of a performance in 2013, kind of lagging the other markets until recently in 2014. And then the ProShares Ultra VIX short-term futures, that's 2 times the fund that we know of as the VXX. I know there's a lot of interest in the volatility-related exchange-traded funds or exchange-traded notes. However, just because I spend so much time on VIX, especially when I'm doing presentations with Interactive Brokers, I'm going to note that we have a leveraged VIX short-term futures ETF, and we have an inverse one as well that gives you volatility exposure, but I'm not really going to spend too much time on those today. Those of you, and I see some familiar names on the attendees today, those of you that have heard me know that I usually spend a lot of time on VIX. These products, I think a week or a month or 2 ago, I actually spent a little bit of extra time on them as well. Now, last year, this was the performance for these leveraged funds. And like for the silver, it was down 64%. The index was down 34%. And the adjusted index would be, well, if we just multiplied 2 times the index. You can see that because these funds, and just sticking with the silver fund for just a second, because these funds are designed to match the daily performance over time and due to compounding, we end up having a little bit of a disconnect between performance. That's why I keep bouncing between the adjusted index and silver. The one with silver, it wasn't particularly dramatic. However, with the financials and with the Financial Bull Fund, you almost had 30% outperformance. The leveraged S&P 500, S&P 500 was up 29.6%. If you double that, you get 59.2%. However, the 2 times ETP was actually up almost 70%. So over longer periods of time, you tend to either underperform or outperform with these funds relative to a longer dated 2 or 3 times performance of the underlying index. These disconnects cause a little bit of confusion. They also, in longer dated options, tend to have somewhat of an influence on the pricing of those options. However, with near dated options, it doesn't quite turn out that way. And just for good measure, I also took a look at how, especially because I felt kind of bad putting a fund up here that was down 95% and not at least giving it a chance to show some decent performance as well. But with the rally that we've had, or I shouldn't say the rally, but the more stable gold price that we've had in 2014, the gold miners have performed relatively well. They did not have the best 2013s, as we just saw. And the index is up 14%, but notice that the ETP has actually underperformed 3 times the compounded performance. So you do get these disconnects, and it's really the best way to look at this is a comparison of this row here, or this column here, and this column over there. And just to just to take a look at the individuals, and these pages were actually more about taking a longer-term outlook. And what I'm trying to look at here is I'm adjusting the performance and taking a look at what happens on a weekly basis. Since we're talking about weekly options, I think looking at, and this goes for any market, not just one of the leveraged or inverse markets, but any market, you want to take a look at what the best and worst performance may be, and what kind of absolute average. And when I say absolute average, I mean on average, how much does the silver ETF change, or the leveraged silver ETF change based on a 1 week or just a 1 week change in the underlying market. And you can see that on average, this fund moves 7% a week. Now that you can take a look at that 7% a week, and if we're coming up on a Friday afternoon and you take a look at the options that expire the following week, you can actually get an idea of whether it's kind of a first look at whether the options may be considered expensive or cheap. The 3 times, and notice that I actually should say, what is 782 divided by 3? The results for these weekly performances actually come very close to 2 times or 3 times the underlying market as well. Now, when we adjusted things for a longer time frame, we started to see a big disconnect from the performance. When we adjust things for just 1 week, there seems to be a pretty close match. 3.62%. If you took 3 times that, the average weekly move for the NUGT, which is the Direction Daily Gold Miners Bullish 3 times shares exchange traded fund, you'd actually see almost a 3 times performance. And this stays pretty steady across all of the funds relative to their performance. Again, the index, the S&P 500, on average moved about 2% a week between January 2007 and April 2014. And you double that, you get you almost get exactly 3.94%. And then the leveraged Russell, and finally UVXY as well, 2 times 6.15%, maybe a little bit of underperformance there, but with respect to the VIX ETPs, we actually, we're kind of used to underperformance in both directions relative to their underlying index. Now, the point behind all of this is that a lot of market participants will approach these leveraged funds with the mindset that you're going to have a disconnect between the longer-term performance of the index versus the longer-term performance of the leveraged ETF, and it just doesn't quite show up too much. It's not that dramatic when you're taking a look at weekly performance, and that actually carries over into the weekly options as well. Now, those of us, I think the financial press is probably more bearish than traders, and hence the S&P 500 continues to stay at relatively high levels, and every once in a while testing new highs these days. But if you have a bearish outlook on the gold miners from here, the financial stocks, for crude oil, we only have the ultra-short crude oil. We don't have a leveraged crude oil on the long side. But if you have a bearish outlook for oil, you got a bearish outlook for the gold sector and the gold miners that have done particularly well, you might take a look at one of the inverse ETPs. And if you take a look at one of the inverse ETPs, more often than not, with the exception of the ProShares VIX short-term futures ETF, these are leveraged and inverse exchange traded funds. And you can see that basically opposite of what happened, more than opposite of what happened in NUGT, the 3 times bearish gold miners fund was actually up almost 180% last year. The index was down 54.42. But the adjusted index, again, there's a disconnect between the adjusted index and the performance, 3 times the annual performance of the underlying index. SDS, which would have kept you short the S&P 500 all year, that is, for lack of a better way to put it, a pretty tough hold for all of 2013. One that's an addition that was not on the other list, a market that was not on the other list, TBT, which is the ProShares Ultra Short 20-plus year Treasury futures. And this one's getting a lot of attention because you're starting to see more and more discussions of potentially higher interest rates, which would push TBT lower. And so we actually have seen some decent performance out of TBT this year. The unleveraged equivalent is TLT, which is also one of the more actively traded funds based on interest rates. And then TZA, this is just the small cap bear. Sometimes I consider the Russell 2000 nomiker that they call it the small cap index. It's not necessarily it's more like a small to mid cap index. I like to think of it more as a domestic index. But in 2013, the Russell 2000 domestic stocks creamed the S&P 500. This year they're lagging a little bit. We'll actually see that on the next slide. As of the end of April, they were down about 3%. You multiply down 3% times times -3 because it's a triple bear fund, you get an adjusted expected performance of 9.48%. However, due to compounding has really taken the wind out of this fund in 2014. Even though the Russell 2000 has underperformed and was down around 3%, that short fund was only up about 1% or so. So you do get some interesting disconnects at times. Looking at the average weekly performance again, and I think the relative weekly performance is a great starting point when you're thinking about doing option strategies. You can just, if you're moderately bullish on, think we're just going to have an up week for the gold miners, maybe 10% for the DUST is kind of a price target that you use if you're thinking about trading the short dated options on that one. As we go along, the funds continue the disconnect between longer term performance really does start to diminish greatly when you get into just a 1 week performance. And you can see this with FAZ, which is a 3 times leveraged, SCO, which is a 3 times leveraged, and where was the one that this is the one that I like a lot. TBT versus the index, it's almost a perfect inverse relationship so far this year. So when you're taking a look at and considering a long or short position in gold miners or the or implied volatility, or even within the S&P 500 or the financial stocks, you can actually look to the underlying funds. Maybe you're bullish 1 week and you're bearish the next week. You can actually use options with each of these underlying ETFs interchangeably based on your directional outlook. I thought it was worthwhile to, after talking about them individually, I just wanted to match them up a little bit on a on a slide where we could see what works fairly well together. And then you could also, with respect, you could take a look at the IWM when you're looking down here, the SPY when you're looking here. There are also, unleveraged long and unleveraged short ETFs that you can also mix in there as well, just based on your overall outlook and how aggressive you want to be with your overall outlook as well. Now here, just those are the funds that you have the opportunity to take a to take a stand based on an outlook on a handful of markets here. While I've been speaking, the new weeklies list popped up, and I was almost certain that there would be a new leveraged one that popped up just as I was talking about other ones, but we did not get any additions to that list this week. So this is where I really got what I really found interesting a few weeks ago is I looked at some 5-day and some 7-day options on comparable markets. And with respect to the IWM, which is the ETF that gives you exposure to the Russell 2000, if you took IWM at 110.03, which was really nice because it's very close to a strike price there, and this was a few Fridays ago. So when I say a 5-day IWM, whenever I say anything short-dated and I cite a number of days, I'm talking about trade days. But the 5-day IWM 110 call was pricing in about a was pricing in about a 2% move. What's interesting about that one, what was interesting about that one to me, is that on average, and I guess this is because 2008 is included in the calculation, but on average we usually get about a 2.5% move out of IWM. Taking a look at TZA, which is the inverse leveraged IWM ETF, three times leveraged. The underlying was right at 1801, again giving me a very, very close to at the money strike, and the break even if you were to buy the call and the put in this case is about plus or minus 6%. So, you know, you could actually take a look at these two markets, and if you felt like you know, next week you're feeling extra risk in the market, you think maybe we're going to get a big move higher or lower, but you're just not sure what direction that volatility is going to be. The TZA options actually on a percent move basis would be just a little bit cheaper than the IWM options. If you're constantly trading IWM options, you know, looking at TZA or the TNA, you know, it's worth spending an extra couple of seconds to see if you can find a cheaper alternative there. It's usually just slightly cheaper there, but TZA would be a cheaper alternative to buy a straddle based on expectation of extra volatility out of the Russell 2000 over the following week. And then I also took a look at 7-day options based on TLT and TBT. And again, TLT is the unleveraged long version of TBT. And I do think that, you know, especially with a lot of the commentary that we've gotten lately, you haven't heard a lot about the fixed income markets as of late. And both days driving into work in Chicago, heard a lot of commentary on Bloomberg Radio regarding what's going to happen with interest rates this year. Well, TLT and TBT are both instruments that you can try to play some sort of move from. However, again, taking a look at the straddles, the break even for the inverse, and again, I'm just talking about a volatility play here, but the break even for the inverse is around 2.58%. The break even for the regular old TLT is 1.39%. Now you double that 139, and you get, you know, TLT options again being slightly more expensive than the TBT options. And that was somewhat consistent. There were slight differences with short-dated options, but the unleveraged, and maybe it's because the longer-term performance, there are disconnects at times between the leveraged and the unleveraged funds, but it seemed to me, I just consistently saw the leveraged options. You need a 2.58% move, but you would expect this TBT to move twice as much as TLT. So, you know, even though they look like very volatile, I started to use the word crazy, but very volatile trading vehicles, their options on a relative basis seem to be a little bit cheaper relative to their unleveraged cousins or however you want to relate those. So, you know, the direction funds is the issuer of the, I had a list in front of me so I could circle back, but direction funds is DUST, FAZ, and TZA, basically the gold miners, the Russell Financial Bear, and the Russell Financials. The ProShares are the guys that actually issue the crude oil, the S&P 500 fund, and then we also have ProShares, which puts out the SVXY and UVXY as well. So, you know, either of those websites are a great place to get a little bit more information. And most of the fund companies that issue leveraged funds also put up some pretty good education that describe how come we see that longer term disconnect. And then, oh yeah, I do need to say, and because we were talking about specific funds, and they asked that we include a link to our options disclosure document, which I believe Interactive Brokers would also deliver to you or give you a link to if you opened an option account. So everybody should be familiar with the options disclosure document if you are trading options. So every Wednesday midday, which is really funny because this always happens while I'm doing an Interactive Brokers webcast, a new weeklies list is put out by CBOE. And you know, cboe.com/weeklies. You can get it in just an old school format on a web page. You can actually download it into a spreadsheet as well. Every week I actually put up a blog on CBOE Options Hub. I focus in on any recent trades that have caught my eye using weekly options. Last weekend I talked about, it looked like somebody was setting up for a bearish outlook for real estate in the next couple of weeks with a bearish spread in the IYR exchange traded fund. But I think teaching with examples is a great way to go. I'm actually trying to get that next week in weeklies blog. It says Friday and Saturday. I'm trying to get it to be more like Thursday and Friday to give people a jump on the following week. Whenever I just came out of a meeting where I've been told to go buy about a dozen plane tickets. Whenever I'm going somewhere to speak in public, like I told Cynthia, she should come introduce me. I usually put that out on Twitter. And then if you have any follow-up questions, Rhoads@cboe.com is a great way to get hold of me. I love questions. I'm very biased toward Interactive Brokers because I always get some really great questions out of Interactive Broker clients. So mention which webcast you listen to, and that kind of helps me get my mind around what your question may be. But do not hesitate to ever use that email address if you have questions about the overall markets. So with that, Cynthia is unmuted. She's just
I
very
am.
quiet.
I snuck in, but if there are questions for Russell, now is the time to actually enter them into the chat panel. And while we're waiting for any questions, I do have a piece of business, and I'm actually jumping ahead of you this time, Russell. Now notice what I have done is I've opened up a polling panel on your screen, and there are 3 short questions there. I ask your help in answering those questions, and actually 2 are multiple choice, so we do try and keep this easy. Notice number 2 has an input field there. That's not where to put your questions, but it does make a great spot if you do have any comments or suggestions on other topics you'd like to see covered in these webinars. But you will have to type quick. There's only about 20 seconds left to that poll. Now, when you have finished, notice there is a submit button in the lower right-hand corner. That will allow me to compile those results. Now, for those of you who have finished the poll, you can simply close that polling panel down using the X that's included in the title bar. Now, your chat panel may have been collapsed, so simply locate the chat panel and double-click on that title bar to reopen it and send us any of the questions that you may have. Okay, poll did end, so I want to thank everyone for that input. And it looks like what I have just seen. Oh, okay. Now, I'm not sure if you're seeing these chat questions. Are you seeing chat questions?
My box shrunk. There we go.
Ah, there it is. Okay.
There we go.
You know how to get it back.
Jan, okay. A couple of really, really good questions here. First off, when to build a position, you know, it is dependent on your timing outlook. And what I'm going to do is I'm actually going to stick with, you know, this is kind of tough without, oh gosh, is there a way I can pull up a board and just write on it?
Yes, you can. If you look in the upper left, you'll see that blank white square. That's a whiteboard. All right. So click on that, and then you have your pencil
blank what?
And line. There's a box that will allow you to, oh, wait a minute. Open up. Let me see if I can open one.
Let me see if I find a slide that has some white space.
Actually, it's under the Share menu, Russell. You'll see Whiteboard.
Aha! All right.
There you go.
Okay. So I'm going to give you, first off, if you're thinking about some sort of catalyst trade, it's usually fairly straightforward. If you're thinking about some sort of catalyst trade, and I'm going to stick with, and this is not a recommendation, but I'm going to stick with the IYR trade that I put up in a blog over the weekend, and I'm going to demonstrate why you would choose why they probably chose the options that they chose. And as I speak somewhat slowly, I'm trying to find it on our website so I can make sure that I have the right trade. There it is. All right. So IYR. Oh, we're not writing in bright purple. Here we go. All right. IYR, and I'm not even sure where it is now. It was at 71.80, and this is personal. You know, it's just I haven't talked to the trader. I don't know what was going on there, but I took a look at they bought, and I'm not going to put 40,000 in, but they bought bought 40,000 of the IYR May 30th 70-50 puts at 54, and they sold, and again it was 40,000. Yeah, and the May 30th 69 puts. Can't you?
We're not seeing it, Russell.
Okay.
Are you?
I think I have to hit enter. Let me finish typing it. I think it'll pop up.
Okay.
There.
Ah, there it is.
Okay, there we go. So, apparently I have to move the thing. So this was the trade. We had IYR at 71.80. They bought 40,000 of the IYR, 70-50 puts for 54 cents, and they sold, you know, the 69 puts at 18 cents. It was a cost of 36 cents. If we get IYR down to 69 at on the 30th, which is the last day of the month, you would have a profit in this trade. Now, the reason that my guess is, and honestly, this is a guess, but there's some logic here. There are like 4 economic numbers the week of May 30th that are related to the real estate market. There's a Schiller Home Pricing Index. There's another economic number. I've got the list of them here as well. Yeah, FHFA Home Price Index, MBA Mortgage Index, pending home sales, and the Case-Shiller Composite Home Price Index all come out just before the May 30th options. So when to build the position, they're actually kind of early here, if you think about it, because this was a trade that was done, goodness gracious, like May 10th, I believe, so about 20 days in advance. However, they're basing their trade on, and every option trade should be based on what they think is going to happen with the underlying market, and in this case, the underlying market is IYR. So IYR was at a pretty high level to where it had been historically, and I think we were also having one of those runs where we were making a new all-time high in the S&P 500. Their timing was pretty good because IYR is down to 70.50 now, and we still haven't gotten to the news event. So what they're trying to do here, they bought an out-of-the-money put, they sold a farther out-of-the-money put. They're going out of the money, and I assume they're going out of the money partially based on their price outlook, but also to not have too much time decay working against them. I didn't look at the other option contracts, and in fact, maybe I'll do a follow-up blog on this one. So they're avoiding the time, they're trying to not pay too much for time value. And their outlook, again, was based on something after a catalyst, and there's going to be 4 catalysts the week of May 30th. So I think they chose the strikes, because if I was the one that had done this trade, and trust me, it's a 40,000 lot, I did not do this trade. But if I was the one that did this trade, I think the lack of time value in there, not buying an at-the-money option contract, going a little bit out of the money, and maybe either pulling up a chart and saying, I think the high 60s is where it may trade off to if we get some bad news. But that's why, that's where the strikes would come from. And you asked 1 week before. Well, in this case, it was just before, it was early enough that maybe the options were not overpriced relative to catalysts at the end of the month. Also, the overall stock market was higher, and the real estate stocks were higher than where they are right now. So, it's all of those moving parts that came into place. Before, I did this by looking at what their trade was and then backing into it. If I were, and I actually worked at a real estate hedge fund for a couple of years, if I were still at that fund, the first thing we would do, the first thing that we would do is take a look at where we thought a stock was going to go, and then we would actually implement some sort of option strategy. So taking that into account, we've got some potential negative catalysts at the end of the month. The fund, IYR is relatively high to where it had been over the past few months, and the slightly out of the money puts would probably give us the most bang for our buck. You still get 18 cents a time value from the 69 put. I didn't look at the 68.50 or anywhere farther out, but I'm actually going to do that exercise and maybe do a follow-up blog since we have a 3-day weekend. So this is why I like IB clients. Seriously, you guys give me some of the best questions and the best things to think about. Let's see, is time decay of a leveraged product options the same as the non-leveraged product? It actually, and I'll back up to, not that one, but this one. I didn't mention it in terms of time decay, but if you have TZA and you have 54 cents and 55 cents, your break-even's around 6% out. If the break-even is, let's say it's exactly 2% out here, you're getting, you're taking on the same kind of risk to take in some sort of, to benefit from some sort of time decay. So, if you really want to split hairs, you can say that there's more time value based on how far out the break-even is for this straddle relative to this straddle. But as far as the way time decay works for at-the-money option contracts, it is, basically it's basically the same as with the unleveraged products versus the leveraged products. So I did try to look at some time decay examples, and they all seem to match up fairly closely. Now, I do think that because of the longer term disconnect in performance, there's a perception that the leveraged options should be a little bit mispriced, should be priced a little bit lower. However, because when we took a look at the weekly performance, of leveraged versus non-leveraged, it didn't seem to really justify that that mispricing. So you can really think of it. I think the way you want to take a look at it is that you would expect the same time decay benefit relative to the risk that you take on if you're selling options. When you flip these around and think about instead of break even, if you bought them, where you start to incur losses if you sold them. So time decay leverage. 3 to 4 times ETF lose value over long times. Is it a good strategy to buy LEAP puts or sell LEAP calls? That is a follow-up for another webcast, and that is also a thought that I had after I sent this to, I'm not even going to say his name, but somebody that Cynthia and I are closely related to as far as getting these webcasts together. I actually have to get them to a compliance department about a week in advance, and right after I sent it in, I was like, damn, I should have looked at the, I said damn on a webcast, but I was like, darn, I should have taken a look at the LEAPs and seen if there were some overriding opportunities there that look better than the non-leveraged. So I think the answer is I wish I had done that work, and I think there may be something to do there as well. So I have a funny feeling that Gian, I hope I'm pronouncing that right, has given me 2 things to either blog on or possibly do future presentations on as well. And the question, I just got a question about, does the gamma reflect the 2, 3, and 4? Yes, the gamma does reflect. It does reflect those sort of moves, and in fact, it might even be a little bit more accentuated when you get farther out of the money. Part of the problem with trying to take a look at how much gamma, what the impact of a big price move is going to be, is that we're looking at such short-dated options. You go out just a few strikes, and you don't have, when you get too far out of the money, I think the math kind of falls apart when you're taking a look at what's being reflected, because you might have one person that came in and bought way out of the money, let's just say way out of the money TZA calls because they thought the market was getting ready to tank, since this is an inverse fund, and that might skew them up somewhat. So I think with short-dated options with so little time value left in those options, sometimes it's a disconnect as well. I wouldn't be surprised if it's reflected differently, but it may actually be reflected, it actually may be lower than a 2 to 3 times move, again, because you start to get that disconnect when you have a longer time horizon with the inverse and the leveraged ETFs and the inverse leveraged ETFs. So, now Cynthia, did you see any questions that I didn't see?
No, I think that's all the questions that we have today. So that will bring us to the conclusion of our webinar. Actually, Russell, would you take this back to your last slide with the contact information?
Oh, sure,
so that
I apologize.
everyone has a chance to access that information before we do drop off today's event. But I do want to remind you that today's slides, including this information with clickable links, will pop up as you exit today's event. So definitely do follow Russell. He's quite prolific on with his blogs and Twitter, so definitely someone worth following. Well, with that, Russell, thank you so much. Once again, you've brought some very interesting concepts. Now, I also want to thank the CBOE and Russell, because it's their dedication to educating traders that makes these events possible. Now, Russell, again, I keep talking about how prolific you are, but I do want to mention that we have quite a few webinars that are archived on our website. If you go to the education menu, you'll find a link to webinars, and there is a button there that will take you to our archives. All of Russell's events will be listed under the Industry Sponsor Webinar tab, and you can actually filter for just those that Russell has provided with the links that are included on the top of the page. Now, today's event has been recorded, and you'll all get access to today's recording if you do want to come back and review the concepts that Russell has discussed. Now, also, I want to put a plug in for next month's webinar coming up, and we usually do these webinars on the Wednesday before Option Expiration Friday each month. Now, on June 18th, Russell's going to be talking about methods for getting short volatility. So another interesting topic we're looking forward to. So thanks, everyone, for your participation with us this afternoon. Simply use the X to exit today's event. Want to thank you, too, for your participation this afternoon. So everyone, please remember to trade smart. So thanks all. Have a good one. And thank you, Russell.
Thanks a lot. I appreciate it.